Perfect. All right. Yes, perfect. So we have gone over entries, gone over our entry checklist. We know how to find our drawn liquidity. We know how to get involved right now. We know where to place our stop loss or take profit. Again, take profit. I would advise first 1 to 2. And then afterwards, you are, of course, targeting the context. Once you are more advanced, you're targeting the context high or low. But first off, 1 to 2, you know when to go break even based on order flow as well. You know when to place your stop loss at the right point, at the right order flow point, etc., etc. So what else is important? Well, the next step we need to take is if we are in an entry, we need to have risk management. Of course, before we get into the trade, it's also important to have risk management. That is why I advise you first watch all the enrollment videos. So again, we still have 2 weeks to go. And then afterwards, you can potentially go into the live market, etc., and take live trades. Now, right here, what is our risk management approach? I will give you an advice, and I hope you do use the advice to your advantage, because I believe, and through all my experience, etc., I believe this is the correct approach that you should also take, especially when you're just starting out. So first off, I want to talk how many trades are we taking in a single day. That is very important because sometimes people and risk management and psychology, they go hand in hand. What you need to understand, risk management is keeping us in the game. Literally, if you don't mess up your risk management, there's no reason to fail. As crazy as it sounds, when you have your risk management correct, there's no reason to fail. And that is exactly what we are going to go over right now. There's no reason to fail anymore if you just stick to the risk management. From my experience in the past, the only time when I was in huge drawdown or when I blew an account was because I didn't stick to my risk management. It's the only thing. And psychology and risk management, they go hand in hand as well. So limiting our exposure during the day, because you need to understand, especially when you're getting to bigger capital, when you're getting to making more money, every time you take a trade, you are exposed to the market. Your capital is at extreme risk. Even if you are only risking 1%, maybe 2%, 0.5%, whatever it is, you are at extreme risk of losing everything because you can't know what happens next. And that is extremely dangerous, of course. So we limit our exposure by only taking 1 trade a day in the beginning. After a year, if you notice, maybe I'm ready to take 2 trades a day. But again, the reason why that is, you need to understand the reason. I think that would help you to also follow the rules. If you understand the reason why I personally only trade 1 trade a day. I take 1 trade a day. And if it's a break even, a win, a loss, doesn't matter. I quit after that. I completely quit. So I took 1 trade here today, actually. This trade ended up being a break even right there. And I quit for the day. I don't do anything else. And the reason why, after a win, after a loss, after a break even if you don't notice it or you're not aware of it, your psychology and your technical reading capabilities are affected in some way or another. So limit yourself, especially in the beginning, to 1 trade a day. Win, loss, break even, doesn't matter. Because after that first trade that you took, you are affected. Believe it or not, you are not the same person anymore. You are affected. And that is extremely dangerous because then when you take another loss or another win or another break even, doesn't matter what it is, because if you are taking win after win after win, your confidence is sky high. All of a sudden you take 1 loss and you think, let me recoup it. I can easily get that back. And then you start losing. That is extremely dangerous, especially when you're working with a lot of capital. You want to limit that exposure to the market at all times. So only taking high probability setups. And when you do take a high probability setup, you are focusing on 1 trade a day. That is the same for risk management. How can we approach trading multiple pairs, multiple instruments? When you see the list here that I'm interested in, that might be a lot, right? It's a long list right there, might be a lot. And people can see that I'm trying to, or people can see it and interpret it as I'm trying to trade every pair that is on this list. That's not what I'm doing. what we did in the higher time frame and what we will do in the MMP week as well, we form an interest list. Through the filtering process, we have an interest list. Now, if you're using a flow trading plan, it's a little bit different, of course. But here we have an interest list. So Euro Australian dollar was at the top of my interest list. If I look at Euro Australian dollar in the morning, morning for me is London session, and I see it is still interesting for me to take a trade on, then I only look at that pair for that day and I don't do anything else. I don't execute on a different pair or a different instrument. I only look at that instrument and I execute on that instrument. If it doesn't present a setup, perfect. Then there's nothing for me to do that day. If it does present a setup, perfect. I take it. Win, loss, break even, I'm done. It's constantly one step, one pair for the day, one trade for the day, done. That's it. So that is also very important to understand, because if you're flicking through pairs, flicking through instruments during your trading day, that is extremely detrimental and can only lead to impulsive actions, etc., etc., etc. That's not what we want to do. So then afterwards, once we do approach an entry, what kind of risk do we want to use? Well, that is going to be important. Again, the funded guide itself will already tell you that. So this is more so when you already have an account, etc. What you want to be focusing on is you are focusing on always creating a buffer before you scale to the next percentage that you want to use. And when we lose a certain amount of percentage, we want to drop back in our percentage that we are trading with. Now that sounds very vague, I know. I will explain it. So what we want to have risk parameters. What I mean by that is that if we have a fresh account, for example, and we trade a 10K account, then we will risk at the beginning 0.5%. Whether we win that trade or we lose that trade, that is extremely crucial, because that is where your risk parameters come in. So if we win, we up the risk to 1%. Whether we win or lose that next trade. And again, I'm using the premise that we are aiming for 1 to 2. That is important. That is very important. If it's not a 1 to 2, then this would not work as intended. Now, aiming for more, that's perfectly fine. But a 1 to 2, that is what you will be starting off with. So a 1 to 2, 0.5%. If you take a 1 to 2 trade, you will win 1%. So when you're at 1% profit right there, you want to again risk 1%. If you win that trade or lose that trade, that doesn't matter. The next trade that you take after that 1% win or lose, you again use 1%. The reason for that is because you want to have 2 consecutive trades with the same risk amount. If you don't have that, then you will constantly be in that break-even cycle in the beginning. Now, that is usually what happens in the beginning, because in the beginning, people usually have around a 50% win rate, and it will slowly increase to 60, 70, 80, even 90 over time when you are used to the trading plan. But in the beginning, it will be like 50%, sometimes even 40, and sometimes 60 as well. But if you're at that level, then it's very likely that in the beginning you will be in this break-even cycle if you don't apply the right risk management. Because again, if you do apply the right risk management, there's no reason to fail. You can't blow an account. The only thing you can do then is profit. And that is the beautiful thing of it. So win or lose right there, use 1% risk again. If we lose with 0.5% risk, we want to again use 0.5% risk. Same premise as what we mentioned earlier as well. Until we reach that buffer again, where we can now allow ourselves to risk twice or in a consecutive row. So 1% and 1% again, whether we win or lose. That is very important. So again, that boundary is 1% profit of the total balance. So again, that is 10,100. Once we reach that again, we can again use 1% risk twice in a row. Then the risk parameters are, if you reach a certain amount. Now, I would not advise this in the beginning. Just take your profits, cash out, and do whatever you want with it. Invest in challenges, etc. Not financial advice. But what you want to be doing is at a certain point, if you're trading a personal account or even you're trading for an investor or whatever, everything besides a funded account, in a funded account, I would say, and I would argue, just take your profits and cash out, etc. Go for your payout. But at a certain moment in time, for example, you're at 10,800, so if you made 8% profit, you can look potentially to take 2 trades with 2% risk right there. And again, you want to make sure that you're taking 2 trades in a row with the same amount of risk. The same for when we reach 4% drawdown. The important thing to understand is when we reach drawdown, so when we get into drawdown, and we will experience this, don't worry, it will come. But the drawdown is not that significant. It's not that special. If you can keep your risk management in control, and that is also goes hand in hand with keeping your psychology in control, then you will never blow that account. Never. But the thing is, people start risking more usually when they go into drawdown. Whenever you go into drawdown, you want to drop your risk significantly. So what I mean by that is everything below that risk. So let's say we lose the first trade as well, and then we risk 0.5% again, then we are in 1% drawdown in total. We can do the same thing. We can keep on risking 0.5% until we are at 4% drawdown. 4% drawdown itself, you can also risk 0.5%. But when you're below 4% drawdown, you want to be looking at 0.25% risk per trade. That is extremely important to understand as well. So the reason why you do that is, again, because when you apply this, and the only thing it takes is time. And drawdown, yes, it is very boring. It is extremely boring. It is, but we will experience it. Now, again, with our win rate, it is very rare to even come across a 10% losing streak. Or, sorry, a 10 trade losing streak, not 10%, 10 trade losing streak. 10%, that's extremely rare because we need to lose a lot of trades in order for us to reach that. But 10 trade losing streaks is already extremely rare, but doesn't mean it can't happen. That is important to understand, right? Doesn't mean it can't happen at all. The only thing that keeps us in the game is risk management. That is very important to understand. So these are the risk parameters that you want to apply. Then again, you use the 0.25% until you are above 4%, and you can allow yourself to use 0.5% twice in a row. And then you can slowly start scaling back until 1%. And it's boring. It will take time. But usually people don't want to do the boring stuff and they rather just blow the account. Now, imagine if you have a funded account. Imagine if you trade for investors or your personal account. You can't do that. That's extremely risky, especially if you're doing this full time. It's extremely risky to do that. And even if you're not doing this full time and you're not relying on your trading income, then as well, why would you do that? Doesn't make sense, right? So that is how you would approach that. Now, the reason as well, why don't I trade multiple pairs, multiple instruments? You can if you are a position trader and a short-term trader. So what I mean by that is you are entering on the 4-hour or above. You can enter multiple positions. That is fine by me. But what you do want to be focusing on is that you're not risking 1% on every single setup. Because eventually when you're taking 5 setups, you are risking 5% of your capital at once. It's a lot. So you want to, if you're trading 4 setups, for example, you want to look at 0.25 at each of those setups. So in total, you have 1% risk. That is what you would want to be doing. So when you apply this, you're essentially never getting out of business. Never. Because risk management keeps us in the game and it allows us to do what we do. That is also why we don't trade NFP, CPI, and FOMC. And I need to say this because CPI, NFP, and FOMC entering on the news release itself. So once it's dropped, you would enter. That is extremely dangerous. Why is that dangerous? It can slip your account and it can take you out for multiple percentage. Or it can even blow your funded account or whatever your account, right? So in that case, you are almost risking your full account to make maybe 5%. Is the RR worth it in that case? No, because in that case, you would need to win 100% of the time in order to be successful. So it's essentially just you're asking for it. You're asking yourself and you're asking the market, just please blow my account. That doesn't make any sense to do. That is just nonsense. It's futile. It doesn't make sense. So that is why you don't trade it, because there's no risk management involved. It's also the reason, because then it becomes gambling. That is gambling because there's no risk management involved. There's no math involved. So it's just gambling right there. That's also what you want to be careful of, right? Then as well, for your risk management approach in itself, and I'm talking about when you are in the trade, so your take profit, your break even, etc. Whenever you want to take a new trade, so when you're more advanced, and again, for the first year, I just wanted you to take one trade. No other trade, just one trade. Focus on one trade a day. When you get more advanced and you want to scale into the market eventually, I'm talking about advanced as in you have 1 year of the same trading plan experience. That is for me advanced. And you are shown to be profitable with that. Then eventually you can look to scale in. Whenever you add on extra risk, you want to make sure that the first trade is no risk at all. So you want to be break even. Always. Then as well, if you want to aim for more, I would always advise taking 80% off. 80% off at 2R and being break even right there. And then letting the rest run to whatever target you have in mind. That is how I would go about it. I personally don't take partials because I don't think they're worth it. I like to take everything off at 1 to 2. And that's what's worked for me. Now, maybe in the future, I will do it a little bit different and I will go with partials. But again, you will notice that as well. And then for your stop loss. Now, your stop loss, you know where to place your stop loss. But for your break even, I just want to mention it as well. Don't be hopeful. This trade ended up being a break even right there. I'm not jumping into the market to take that trade right now. I'm not jumping into the market when I saw this expansion higher right there, FOMOing in, and after getting tagged out of break even being like, oh no, I need to get in right now. No, I'm not hopeful. I'm very objective in that sense. Yes, I use logic, but I'm not hopeful. I'm not being hopeful of, it might push higher still. Who knows? It might just tag me out and then go higher. Who knows? No, break even is break even. I would rather take a lot of break evens and then have one winner in between than taking a lot of losses right there. That is very important because the losses, they add up. They stack up. If you can just take 10 break evens and then a winner, you're in profit. But if you take 10 losses and then a winner, well, you're in drawdown. So I would rather have a lot of break evens than a lot of losses. That is very important. And as well, it helps with your psychology as well. So these are the things, how you can apply risk management. And these are the most important rules. Having risk parameters for how much you trade in a day. So one trade a day. Having risk parameters for how much you risk as well on a singular trade. 1%, 0 to 5%. Again, the things we went over right there. And then as well, your break even, don't be hopeful, etc., etc. All right. That is for everything right now you need to know about risk management. And then we will continue with the next episode. All right. Perfect. Thank you.